Here is the number that has changed the mood across Europe this morning. The Eurozone's Purchasing Managers Index, a monthly survey of company bosses that acts as an early read on growth, has climbed back above the 50 mark, the line that separates expansion from contraction, for the first time in 4 months. That single data point is why BNY strategists said today, Wednesday the 5th of August 2026, that PMI resilience is tempering stagflation fears. Stagflation is the ugly combination of stalling growth and stubbornly high prices, and until this week markets were quietly pricing a rising chance of it. The euro is now being judged less on fear, and more on hard evidence. So what changed? Two things collided. First, headline Eurozone inflation surprised to the upside, edging up to 2.9% from 2.8%. Normally that spells trouble, because rising prices alongside weak output is exactly the stagflation trap. Second, the survey data simply refused to cooperate with the gloom. Business activity picked up instead of rolling over. That combination flips the interpretation entirely. Hotter inflation with contracting output signals a stagnating economy. Hotter inflation with expanding output signals genuine demand. Traders reacted by pushing up the implied probability of a European central bank rate hike, because a central bank only raises borrowing costs when it believes the economy can actually absorb them. The consequences are already visible in currency markets. The dollar fell around 1.4% through July as American payrolls softened and consumer price inflation cooled, while Europe delivered the opposite mix. That contrast matters in practical ways. A firmer euro against the dollar makes imported goods and dollar-priced travel cheaper for Eurozone households, but squeezes exporters such as German carmakers who earn in dollars. Meanwhile, American growth slowed to 1.5% in the second quarter, and U.S. borrowing rates have reached their highest level since June 2007, lifting credit card and mortgage costs. The turbulence is global. Japan confirmed coordinated yen buying intervention with the United States to steady its own currency. So where does this go? The near-term path hinges on whether the PMI Rebound survives a second month. 1, reading above 50 is a signal. 2, make it a trend, and the ECB will not tighten policy on the strength of a single survey. Watch the next inflation print closely. If prices push beyond 2.9% while activity holds up, a rate rise moves from possibility to expectation, and that typically lifts the euro further against a dollar already weakened by a slowing American economy. If activity slips back below 50 while inflation stays sticky, the stagflation conversation returns immediately, and it returns much louder. So the takeaway for the 5th of August 2026 is this. Europe has not solved its inflation problem. At 2.9%, prices are still running well above the ECB's 2% target. But it has bought itself breathing room by proving the economy is still growing. Stagflation fears are tempered, not cancelled. For investors, that argues for treating euro strength as data-dependent rather than structural. For everyone else, it means the cost of borrowing in Europe is now more likely to rise than fall in the months ahead. Watch the surveys, not the headlines, because right now the surveys are doing the talking.